All right, hello everyone. Welcome. I'm Albert Liu for a Rule Classroom live stream. Welcome to anyone joining us on Twitter X or YouTube. Visit ruleclassroom.com for more interviews like this one. Today, I'm pleased to welcome back Mr. Jason Jessup, who is CEO of Magna Mining and was the focus of our first Do Your Diligence episode back in June when Rick Rule went one-on-one with Jason to discuss the prospects of his companies holding no punches back. That was a great episode. And now Jason is back with some new developments. So I want to bring back Jason, but first I want to throw it to Rick Rule for some introductory remarks. Rick, great to see you. How are you?
I'm fine, Albert. We have a busy day today. In addition
We
to this, I think we have
absolutely do. For those of you out there, we have Jason right now, but then Ross Beatty coming up at 8 a.m. Pacific time. So, Rick, what are you and Jason going to be talking about today?
Well, you'll recall, Albert, that we did a special session with Jason, Do Your Diligence. The idea being that we allow the Rule Classroom members to watch due diligence conducted live, learning how to interrogate companies around their presentation and how to make investment decisions. I think that was a wonderful session. We had Jason on at the suggestion of a longtime friend of mine, Jonathan Goodman of Dundee, with whom I've done business with for 40 years. Jason is exploring and developing in the Sudbury Basin the premier nickel, copper, cobalt, platinum group metals area in North America, a very venerable area. And importantly to me, Jason is located himself in Sudbury. He doesn't try to explore Sudbury as an example from Vancouver, but rather lives within the city limits of a town that has 2 smelters and 6 or 7 mines. And we had a fascinating discussion, I think, around in particular nickel projects. Current viewers of the Rule Classroom will know that nickel is deeply out of favor and hence of a lot of interest to me. And what attracted me to having the interview with Jason was the fact that despite really, really, really depressed nickel prices, the company had a couple of projects that appeared to me to be not just economic, but potentially highly economic in this price environment. And it appeared to me, too, that they could be the anchors of junior property consolidation in the Sudbury district. Today, Jason comes back and talks about advancing that strategy with a recent acquisition that they are doing from the number 2 producer in the Sudbury Basin, a potentially exciting development. But the devil, of course, is in the details. And Albert, hopefully today, we get to tackle that devil and get into the details.
All right, then without further ado, let's welcome Jason Jessup, CEO of Magna Mining, to the conversation. Jason, we're hoping to get some of those details from you today. So why don't you start with some introductory remarks, and then we'll get Rick back to, go into more detail with you.
Absolutely. And yeah, it's great to talk to you again, Rick. And, I'm thrilled to be here. Last time we talked, I think I was excited and optimistic about what the future held for Magna. And it's great today to be able to talk about the acquisition we just announced last week and our new PEA that we came out with earlier this week. So lots of exciting things happening at Magna and falling exactly within our strategy we've been talking about for years now. I can jump right into my presentation, Rick, unless you have a few questions to kick things off.
No, let's get right into the presentation, but I want you to give the presentation in the context of how these assets fit into your existing assets and how, if in any way, this changes the schedule and the capital requirements that we talked about in our previous discussion.
All right. All right. Well, if everyone sees my screen, I will jump right into it.
Yeah, looks good, Jason.
Perfect. So Rick, as I was saying, our strategy has stayed the same basically since inception. It's all about near-term production, making new discoveries, and acquiring other properties and mines in the Sudbury Basin that are synergistic with our current team and our current assets. And what we've accomplished in announcing this signing of this definitive agreement to acquire the KGHM properties, it fits in perfectly with all of these. And it fits in very nicely with our existing Crane Hill project as well as Shakespeare. So I'm going to get into some of these details, Rick, but feel free to just jump in and ask questions. So the transaction, really, what is this? We were able to acquire a number of past producing mines and exploration properties from KGHMI. These were the former FNX properties, excluding the Victoria property, which KGHMI is going to keep. But it includes the producing McCreedy West mine, the Levack and Podolsky mine, which operated and went on care and maintenance in 2019 and in 2013, respectively. The past producing Kirkwood mine and 4 other exploration properties. To remind everyone, back in 2000 and from 2008 and then 2011 when I left, I was the running the operations at the McCreedy West and Levack mine. So these are mines I know extremely well. I think when I was in charge of operations there, we operate them very efficiently, very productively. So then the question is, how much did we pay for all of this? And it is it took us a long time to negotiate this deal, a very long time, but we were able to come up with a deal I think that is unbelievable. So cash on closing of $5.3 million plus an additional $2 million worth of Magna common shares priced at closing. There's an additional $2 million deferred payment before December 31st, 2026. And we're taking on approximately $10 million in closure liabilities. And there is also some contingent payments based upon future milestones of reaching commercial production on some of the non-producing assets. So, overall, very low cash up front, deferring some of that payment price, taking on some long-term closure liabilities, and then having some milestone payments. So, I believe for a company like Magna, this meets our goals and my goals as a shareholder, not to have a dilutive acquisition. I think we've done a great job negotiating this. So then the question is funding. All right, how are you going to pay for this? We had Desjardins as our financial advisors on this, and they were able to work with their lending team to provide us with a commitment letter for committed capital for a $10 million 3-year term loan, as well as a $10 million letter of credit facility, and that would be used to cover the closure liabilities. This is still subject to the final documentation, but it is committed capital within that company. So based on the purchase price and this commitment letter from Desjardins, we're in a position to close this financing without actually needing to raise any money. So this map that I've shown many times now, I'm so excited to be able to show the additional properties that would come with this acquisition. So, I've talked lots about Shakespeare and Crane Hills, you see in dark blue, but then, the other properties are located around the Sudbury Basin and in the footwall of the Sudbury Basin, with McCreedy and Levack being connected next to each other in very close proximity to Glencore's Strathcona Mill. And McCreedy right now does have an agreement in place to sell nickel ore to the Strathcona Mill, and there are other copper ores selling to the Clarabelle Mill. But yeah, it's a nice mix and a nice spread across the basin. So what does this do for our company? I think it's such a transformational transaction. Being able to, upon closing, become a producing copper company with optionality to turn on nickel when the timing is right, I think really sets us apart from other juniors. And not needing a huge amount of capital to do that is pretty exceptional. Um, and with the Levack and Podolsky mine being on care and maintenance and in very good shape, it allows us that pathway combined with Crane Hill to move things forward. And potentially we have the ability to have 2025 production at McCreedy West mine, development starting with Green Hill, in 2026 restart of Levack mine with production ramping up at Crane Hill, and then potentially following that in 2027 a potential restart of the Podolsky mine. So by the end of 2027 there is potential to have 4 producing mines in Sudbury. So this again very forward looking, but it's very easy to see that pathway of growth, and having familiarity with the Levack and McCreedy mine. I believe our team, we're highly confident in what we can do with those 2 assets, and the work we've done on Crane Hill. We're very, very optimistic that we can move that forward. With the permits we have, all the drilling and knowledge we have, and the near surface resources that we could mine. We just think that again, it's a very low risk type development. One of the great things that I haven't spoken a lot about is the operational synergies. So as we've spoken before about Crane Hill and what we'll need to move that forward into commercial production, there's a lot of things we'll need. We'll need a complete team. We'll need procurement. We'll need health and safety policies. We'll need the accounting back office to operate the mine. There's a lot of things we'll need, but with this acquisition, we are acquiring that. We're acquiring a full team right up to the mine manager and manager of technical services at the McCreedy West mine, and we can leverage that at Crane Hill, which is not just de-risking, but it's also going to have some great cost savings. As well, there's a lot of equipment that we can use with this acquisition that can help us reduce the capital cost potentially at Crane Hill. There's a mine power center that was never installed. It's in storage at Levack mine. That's exactly what we need for hooking up to grid power at Crane Hill. There is a sample tower at Podolsky that we could use early on at Crane Hill to help reduce that pre-production capital cost. There's ventilation fans for the underground at Podolsky that we could use again to reduce that. So there's potentially millions of dollars in operational synergies between the acquisition properties and Crane Hill. Now the resource growth, and I'll get into that a little bit, but we've come up with our own NI 43-101 resource that we announced with the signing of the definitive for the McCreedy West mine. It sits at about 9.3 million tons, and I'll get into that a little bit more. There's also an additional approximately 17 million tons of historic resources on the other properties. Combined with the new resource we put out, the new underground resource for Crane Hill, that's over 18 million tons in the indicated category. We're starting to grow a very significant critical mass of resource to mine in the future. And then the exploration potential. Our team, is largely made up of the former FNX employees, including some of the people like Dave King, who have made some massive footwall discoveries while they were with FNX. Having these properties like McCreedy West and Levack on the North Range, I couldn't be more excited about the footwall exploration potential, which was not a focus for KGHM at all. We're really excited to get some drills turning there. So a little bit just very quickly before I jump into some verify slides. So McCreedy West was an old Inco mine. It operated from about 1970 to 1998, shut it down. FNX reopened it in 2003. In 2023, produced 317,000 tons at about 1.6 copper, a little bit of nickel, and about 2.5 grams. It was a mine that was very non-core to KGHM. So there was just enough capital put in place to continue production, but no growth capital put in place. And that's an opportunity we see that, we can grow this production. To speak to when I was operating this mine back in 2008, around the time the financial crisis hit, we had to downsize. We laid off some people as nickel and copper prices collapsed. But at that time, we were mining approximately 2,500 tons a day from McCreedy West mine. Currently, they're mining about 900 tons a day. And the mine is no deeper than it was when I was operating it. So it is, there's still a lot of resource, easily accessible, and potential to ramp up production quite a bit from what it currently has done in the last couple of years. So we'll get right into the McCreedy West mine. You can see the properties are right next to Levack mine. They're actually connected underground. As I mentioned, the resource that we just put out, 1.1 at a 1.1% nickel equivalent cutoff grade, 9.3 million tons. This is made up of 3 different zones. The intermediate nickel contact zone, which is primarily nickel. The 700 footwall zone, which is a copper PGM zone. And then the PM zone, the precious metal zone, another footwall deposit discovery made by FNX Mining, which is PGM rich, low sulfide copper zone, very similar to the 109 footwall zone at Green Hill. So if we look at this nickel contact zone, this was something that FNX mined quite extensively up until 2008. There's been minimal mining done since then. Most of the focus has been on the copper zones over the last, call it 12 years or so. But as you can see, there is some extensive resources left, and also some good grade lenses. So you can be selective in this area and mine some pretty good grades. Typically, back in the FNX days, we mined 1.3 to 1.5% nickel, but there was months that we got in and mined over 2% nickel. But right now, that is not the focus. That's the optionality. And when the timing is right, when we see the next run in the price of nickel, this is a nickel ore body that has infrastructure in place, stopes that are ready to drill off, and the nickel can be turned on very, very quickly. Currently, you can see the resources that are up there. So, pretty significant, over 2 million tons of resource currently, and definitely potential to expand on those. Now, the PM zone, as I mentioned, is a zone that FNX discovered, and we developed back in from about 2005 to 2000 and 2000 well, they're still mining it, but it was probably all developed mostly by 2009. It is a lower sulfide type deposit, has some, very wide zones. You can do some bulk mining. Typically we would operate between 0.7 and 0.9% copper, a little bit of nickel, and 4 to 5 grams in a bulk mining scenario. And this is still a zone that we believe has a lot of potential for expansion.
Excuse me, Jason. When you refer to 4 to 5 grams, 4 to 5 grams of what?
Yeah, platinum, palladium, and gold combined. Most of the weighting is on palladium.
Yep. Thank you.
No problem. But really, what has been the focus over the last number of years is this 700 footwall zone, and this is an area I know very, very well from my days at McCreedy West. It's just an amazing zone, still with over 5 million tons of NI 431 compliant resource. At a 1.1% nickel equivalent cutoff, just under 2% copper and about 0.7 nickel, with a 2.5 grams again, or a little better than that in PGMs. Great zone. When I was operating the mine, we mine this zone narrow vein very selectively, at lower throughput rates, only about 3 to 5,000 tons a month, but at close to 5% copper plus nickel and PGMs. The philosophy with KGHM has changed, where they're going in and bulk mining, and that 317,000 tons they mined in 2023 was mostly from here, with a little bit of PM zone mixed into that, but mostly from the 700 complex bulk mining. So what we saw was there's a lot more dilution than I think we would want to accept going forward. We would want to refine some of these stopes, and hopefully be able to come out with a mine plan that can increase the copper grades in this area, as well as at least modestly increasing production, in the first 12 months. So that will be our focus. But as you can see from some of these intersections, if you can see them on the screen, maybe I can zoom up a bit. Some of these intersections where you have, close to 8 meters at 11% copper and 1.2 nickel, a number of areas where, there's some high PGMs with both nickel and copper. And, typically these veins will run anywhere from, 2 to 5 meters wide. And, there will be little stringers running off of them. So you can do some bulk mining, but I think being a little more selective, we can get some very high grade copper out of this. And there's lots of it there. So even at potentially a 350,000 tons to 500,000 tons a year, potentially many years of mining still just in the 700 complex alone. So Levack mine, and this is a mine that's it's got a special place in my heart. I really enjoyed my time. I'm running this mine. It's a long life historic mine, produced over 60 million tons. And obviously most of that during the years Inco ran it. FNX really focused on the Levack footwall, which was later called the Morrison deposit after Gord Morrison, who's one of our senior advisors. But it is it has all the classic with, contact nickel, high grade copper footwall, and we think a lot of exploration potential. One thing just to note, if you look at the resources, and we'll talk a little more about it, but over 5 million tons of indicated resource, and the contact nickel grades are quite good at Levack mine, with over 4 million tons at 2.1% nickel and 1.1% copper. So the McCreedy West mine and Levack mine are connected. Levack, the shaft is still utilized every day. It is the secondary egress for the McCreedy West mine, as well as for Glencore's neighboring mine. So it is in good shape. We could go and drill from there on day one from underground if we wanted to. And we will be looking at a restart plan for this throughout 2025 for potentially a 2026 restart. So I talked briefly about the contact nickel resource. That's in red, as you can see up here, the main zone, number 7, intermediate zone, number 3 ore body, the number 1, 2 ore bodies. It's a pretty extensive. A lot of these upper levels were originally track drifts. They were mined back in the 20s, 30s, 40s. Our plan, and this is a plan I actually had in place back in 2011, just prior to leaving Quadra FNX, when I was at Levack mine, was to drive a ramp from surface, which would give access to a lot of these upper levels that otherwise are very difficult to access with modern equipment because of the size of the drifts there. So again, some really decent grades of contact nickel with some good copper in some of these zones, and enough to build a mine plan and develop a ramp down to connect to the existing ramp that is at the 950-foot level. So a 950-foot ramp would allow us to access the upper levels of the contact nickel, as well as some of the upper footwall mineralization, which I'll talk about in a minute, but we'll also give ramp access right down to the bottom of the Morrison deposit from surface, which gives a lot of flexibility and could potentially help lower operating costs quite a bit. So the Morrison deposit, which I had the privilege of leading the team to bring that into commercial production, it has been produced some very, very high grades. The resource to the left is still a decent grade at about 4.2% copper, over 700,000 tons. Um, you know, some of that is very remnant and is probably not economic to extract, but there is a portion of it that we will look into going after. And again, it has ramp access, quite easily accessible and connected to neighboring mines that have potential to hoist that ore, as opposed to bringing it up through the Levack shaft and hauling it up that ramp. But again, this will be what we'll be looking at in 2025, coming up with a proper restart plan. Now, Rick, you asked about the exploration potential, and again, this is getting us really, really excited as we've been digging into this over the last year. What we're seeing, so the Morrison deposit, it was discovered and we developed it, fairly rapidly. But just prior to discovering the Morrison deposit, FNX drilled a zone up near surface. And if you can look up near the top there, one of those intersections in what's called the keel zone, um, there's intersections up there that are massive chalcopyrite veins in the footwall of the main zone. And we believe that there's potential for this type of footwall mineralization to extend all the way down to the Morrison deposit. Now, obviously, it's not going to be one continuous vein, but this breccia unit in the footwall appears to have mineralization throughout it. So, getting in there, understanding it, doing some more drilling from underground, and focusing on more selective mining could be, some great high-grade sweetener to mix into the overall production plan. As I mentioned, one of the things I looked at in the past, and actually we had designed a ramp that KGHM never developed, but to come from surface, and we would come right by this keel zone, which starts currently around the 400-foot level, but potentially that could come nearer to surface. Get in there and start doing some silling on those veins to better understand them and hopefully expand on it. But that's something that could happen, very, very early in the restart. So that's pretty exciting, as well as the excitement of coming from the Morrison deposit, Levack footwall, and looking at some mineralization that's coming up, heading towards that keel zone. And again, I'm not going to read out all these intersections, but I think if people read them, it speaks for themselves. These are the kind of grades that you don't see very often outside of Sudbury. So there's quite a distance, about 2.2 kilometers, if you look on dip from the PM zone at the McCreedy West mine to the Morrison deposit. Our interpretation is that breccia zone continues right to the Morrison. And there's been almost no drilling done in this area. Now, back in about 2017, KGHM drilled 3 holes from that 1600 level track drift. And one of those holes hit a 2-foot wide vein, about 0.6 meters, of over 30% copper and 4 grams of PGMs in one of these breccia zones. So, and that's about, I think, approximately 280 meters outside of the existing PM zone resource. So that's a pretty big step out, and like, there's never been followed up on by KGHM. It was just not big enough for them. Again, they were not focused on exploration, but that tells us there's potential for more high-grade footwall mineralization in this breccia corridor, and there's a lot to explore. And that 1600 level track drift gives us a platform to potentially drill that off. So, the upside and the potential to find another significant footwall deposit in this 2.2 kilometer trend between 2 spectacular mines, 2 spectacular footwall deposits, I think is pretty good. So it doesn't stop there. And Rick, please feel free to jump in because we got a couple more properties to talk about. But so our Podolsky mine that we'd be acquiring when this closes is, again, a mine that was an old Inco mine. It operated as an open pit called the Whistle Pit. That was closed and rehabilitated. FNX explored it and discovered a very high-grade copper deposit called the 2000 deposit in the footwall. And they also had discovered the North Zone on surface. A ramp was developed partially into the North Zone, but did not reach the mineralization. It was halted in 2008, but a shaft was sunk in the 2000 deposit operated from 2013 to, or sorry, from 2008 to 2013. Current resources sit at about 6 million tons of contact mineralization below the old open pit, and then an additional about 1.5 million between indicated and inferred in some of these footwall zones. This just shows the layout of the different zones and the shaft. Again, that 2000 zone was a spectacular deposit, massive chalcopyrite. The North Zone also has some very high grade, although it's more pinch and swell, narrow vein type veins. And currently the underground workings are flooded, but the head frame, the hoist, the infrastructure on surface still kept in good shape, and the mine is on care and maintenance. And potentially the ramp could be extended and be able to access the North Zone to restart mining there from surface. And it could ramp over, which is the original plan, to below the pit to mine some of that contact nickel that's below the pit. So this North Zone, it does come actually right to surface. As you can see, again, there are some areas in it that are very high grade with over 20% copper over some decent widths, but it is very pinch and swelling. It's not, I would not say it's not a suitable to bulk mining if you want to keep the grades up, but it is something that we're looking at. If we were to talk about sort of priorities, our priorities are going to be, optimizing McCreedy West, bringing Crane Hill, starting Crane Hill development towards production, restarting Levack mine, and then once the three of those are running, then looking at a potential restart on Podolsky. And again, although the overall resource in the contact zone is about 6 million tons at 0.75 nickel, there are some, higher grade lenses and zones within that potentially, could be mined underground and produce higher grade than what the overall resource is. Again, these are historic resources. Only McCreedy West has a NA 43-1 compliant resource. The others are all historic. And Kirkwood, again, was a past producing Inco mine. It was one of the mines FNX really didn't have time to do a tremendous amount of exploration on. They discovered the PM zone, they discovered the 2000 deposit, the Morrison deposit, and the Victoria deposit, which KGHM is keeping. When I talk to people like Gord Morrison about, why didn't you do more work at Kirkwood, he just says we just never got around to it before, we were acquired. But they did do a little bit of work there and had some success, and we think there's still potential for, more discovery at Kirkwood. It's located right next to the town of Garson and right next to Valley's Garson mine, in a great place, a couple kilometers away from Valley's Frood and Stobie mine, which is a monster mine that operated for over 100 years. Now, in purple, that's the SIC contact. That's where you'd find the contact mineralization. And this blue color is the South Range Sudbury breccia belt. And that's what hosted the Fruit Stobie mine. And there's a significant amount of it that has been really not explored at all. So again, these are historic resources. I'm not going to get into all of it, but there are, call it, plus 2 million tons of historic resources there. But what our real focus will be is in this zone that FNX discovered, and it's called the Segway Zone. It's a small footwall zone, comes right to surface, with some intersections close to surface that run, approximately 5% copper, a little bit of nickel, less than 1% nickel, and about half an ounce of platinum, palladium plus gold. Again, only a handful of holes drilled in this area, but it does tell us that the Sudbury South Range breccia belt does have potential to host footwall deposits. So again, it'll be one of our key exploration properties in the next couple of years. As well, there's 4 other properties that we'll be acquiring that are early stage exploration. I'm not going to get a lot into those. There's a lot to talk about here, but overall, with this deal structure, we're not anticipating a lot of dilution from the $2 million in share payment. Again, we could close this without raising any more equity until post-closing, based on the commitment letter from Desjardins. So, there's been a positive response in the market. I think that there's a lot for people to understand from this acquisition and what it means. But this has been something we've been working on for a number of years. In some ways, this is one of the primary reasons why I founded Magna, and combined with our existing assets of Crane Hill and Shakespeare, and Shakespeare having the potential to build their own mill in the future, and the amount of resources we have between all the different assets plus these acquisition properties, we're creating a critical mass here. I think it's one of the best jurisdictions in North America.
Jason,
So,
thank you very much for that. When Paul reached out to me, your senior vice president, a couple weeks ago, said you guys had some news coming out. He wasn't kidding. That's a lot to digest. Rick, if we go back to Jason's Do Your Diligence interview, one of the things that kept coming up was synergies and scale. I'm really interested to hear what you have to say about this release.
Well, I mean, that's really the story. This potentially, and I want to say potentially, eliminates one of my concerns around Magma, which was scale. As you know, Albert, big mining complexes make you big money, but have big risks. Small mining complexes make you small money, but have big risks. Scale is what you have to look for. You have to look for a circumstance that can make you a lot of money when times are good. So congratulations, Jason.
thank you.
It would appear that potentially, I don't want to concede it yet, but potentially you've addressed my primary concern around Magma. But let's get into it. What's your current market capitalization, roughly?
We're sitting around 200 million Canadian
In market cap.
in market cap.
Great. And how much cash and how much debt do you have?
So right now we have no debt.
Before the deal. Yeah. Okay.
No debt. As of June 30th, we had about 5 million in cash. We had some warrant exercises, 3 different tranches over the last since we announced that. So we have approximately another 3 million in warrant exercises since then. So from a cash point of view, we believe we can get to the end of the year, close this deal without having to raise any more capital. So, yeah, we're in a fairly comfortable position.
What's your existing general and administrative burn before the transaction?
Well, it's growing. I'll admit that, because we have hired a few more senior people to round out the team. But right now we're sitting at about, with everything, probably about 3.3 million.
And how much will that grow with the acquisition? What will be the approximate 2025 G&A?
Approximately, again, and we haven't worked through all the synergies that, between the G&A that we currently have to run the McCreedy West mine and what we'll have corporately. But, I would guess it's going to come in somewhere between 4 and 5 million.
Let's call it 5, just so if we get surprised, it'll be a good as opposed to a bad surprise. And then before this acquisition, Jason, what is the indicated net present values from PEAs, PFSs, or FSs? In other words, if I'm paying $200 million for Magna, what do third-party studies indicate that the sum of the parts are worth at current metal prices?
That's a great question. Well, I think there's been some research been updated since our PEA that we released on Tuesday. And to be honest with you, I've been traveling since Tuesday. So I'd have to look and see what the latest is.
Fair enough. You can owe us that answer.
I'll have to be honest.
But we'd like it. What I'm trying to establish is pre-transaction, what do we pay and what do we get? So that one's in the mail.
Yeah, like prior to the PA that just came out, which I think was, a great improvement over the previous Crane Hill PA. SCP had a, a sort of a NPV of, in the $700 million range. So again, I have to see what that's going to look like now that with all this new news coming out on Crane Hill. But I think there's still, again, people can make their own decisions, but
I'd
still some
like you to
good
answer it.
value.
I'd like you to answer it differently. I realize you can't do it off the top of your head, but the way I'd like you to answer it is to say that the PV5 or PV8 after tax from your PEA or your PFS or your FS is X. You follow me?
So from our
both on Crane Hill and on Shakespeare.
from our feasibility study at Shakespeare as a standalone project, done in 2022 at 850 nickel, we had an NPV after tax of about 140 million.
Right.
It doesn't sound spectacular, but where it really starts to get interesting is when you start looking at what about if you add in Crane Hill. Now,
Yep.
Crane Hill as a selling ore to a third-party mill in Sudbury, as per our current PEA that we just released, we have about $190 million NPV 8 after tax, using 850 nickel and $4 copper. Now, again, not looking at any synergies or any differences in price tag, but what makes it very elegant is the capital costs. And we've been managing our PA that we just put out, and I can pull that up here in a second. So yeah, we managed to get our our overall capital cost down significantly for pre-production. So looking at ADEX of about 35 million net of any advanced exploration revenues, and about 27 million for pre-production capital costs after that. So very modest. And if you look at what is the net after if you take the revenues off of pre-production from that capital cost, it's only an additional 12 million. So potentially some very low capital costs to realize that nearly $200 million of NPV8 after tax from Crane Hill. So,
right. So if you add the two,
spectacular IRRs,
right, and the sum of the parts relative to the enterprise value is very high. I think we established that in the last interview, and that's where I'm trying to get our students. In other words, before the acquisition, we were getting more than what we paid for. Now, I want to talk about the acquisition. If going over the terms again, you have $5 million up front in cash. You have $2 million in share payments. You have, I'm sorry?
Yes.
Is that correct?
Correct.
You have another final payment, and you have some contingent payments. Accurate?
Correct.
Okay. And you have the ability to cover all of these with a $10 million term loan, which is to say you have the ability in the near term not to come out of pocket to get this done, with the exception of the share payment.
Correct.
So let's begin to get into how the cash comes in and how the cash goes out. Is McCreedy West, the current operation, a cash generator at current nickel prices? In other words, is it a source of cash or is it a use of cash? And if it is a source of cash, does it amortize and extinguish the $10 million loan? Where does the money come from?
So, I can't quote exactly what they've reported as EBITDA because it's not audited. But what I can tell you is it's not a nickel mine, it's a copper mine.
Yep.
Probably 70 to 75% of the revenues in 2023 of that 317,000 tons, those revenues were generated by copper from the 700 copper zone.
Yes.
So the great thing about it is there's optionality to turn on the nickel.
Wait. Stop. Currently, does it generate cash or consume cash currently?
It has good cash positive cash flows. Like it will be cash flow positive. It will be able to cover the debt. It will be able to reinvest capital in the first year back into the mine at current operation.
Source of cash. And I realize this is highly speculative, but in your own plan with regards to the acquisition, does the cash flow from McCreedy West fund, in other words, does it extinguish the debt over 3
Yes.
years? Okay, thank
Yes.
you. Thank you. Now, let's move forward. What we've decided is that this is a source rather than a use of cash. We have $5 million in combined G&A, and we have a series of capital expenditures around, sequentially, McCreedy West, Crane Hill, and Levack. Can we talk about the capital needs around those? How much, if any, of that will be covered by cash flow from the McCreedy West operations? And if not, what is the quantum of the cash needed to restart those? And what would you suggest the sources of that cash will be after the $5 million annualized G&A?
Yeah, so that's a great point. So in 2025, and these again forward-looking statements, I would expect that once we close the acquisition, we'll be able to put out a forecast and better guidance. But just in general, very forward-looking. In 2025, I would expect that we would produce positive cash flow. Some of that will go into the studies and the restart of Levack. Now, 2026 restart at Levack has potential based on the cash flows that we've seen historically in the last year and what we're planning on doing, potentially to be fully funded from McCreedy West, so a true bootstrap approach. Because the mine is in good shape and we are looking to develop a ramp to connect up, that's the largest, at this point with the plan, that would be the largest capital cost, is that ramp. So there is potential for that to be fully funded, and this would be after G&A and everything. Now, Crane Hill, again, we're still looking at a gold royalty or stream. Now that the PA is out, we're hoping to have something announced later this fall. Again, there's no guarantee, but that would be our expectation to potentially fund, the first, we'll call it the ADEX, that as per our PEA, that first 15-month period to drive the ramp into Crane Hill. So once that is done, there'll still be some additional capital, and that could again come from cash flow, or it could come from potentially equity, but that would be down the road, call it in 2026. So
will there be any development or deferred sustaining capital expenditure on McCreedy West in 2025 that exceeds the cash generation from two? You can see I'm getting to sources and uses in 2025 and 2026. What I'm trying to do is acquaint myself that you won't pull us through the floor financially.
Absolutely. I know what you're getting at, Rick, and in the back of my head, I'm just thinking of all the things my lawyer told me I can't say. But I'll tell you generally, I think what you need to spend additionally over what the budget was, let's say in 2023, and what they're planning on spending in 2024 for capital at McCreedy, I think an additional 3 to 5 million will go a long way. And it doesn't sound like much sustaining capital, but that would be more than double of what they've spent in the last, annually for the last 2 years. Now, it's not that it's completely capital starved. The mine is a unique mine where the mining, in some cases, is just lateral. So it's just extending, levels just another 50 meters, 75 meters further on extent. It's not like you have to drive a ramp and keep the ramp developing and develop new levels deeper to keep the mine going. When I was at McCreedy West in 2008, we were mining the 1950 level and developing to 2000. The ramp only goes to 2000. So since 2008, all the mining that's been done at McCreedy West has been between surface and the 2,000-foot level. So all ramp access. So it is a very low-cost mine. Now, there will be some new equipment needs to get leased. Especially if we want to increase production, and we will need to put some more diamond drilling in place. I believe exploration diamond drilling is needed. So there'll be a budget for that. But I think, something in the range of 3 to 5 million. And I think that can be covered. That can be covered by the cash flows based on what we've seen. And again, we'll give much better guidance on that. But I do not expect any, really, the biggest capital expenditure I see based on everything we've talked about today will be what we've talked about for the PEA for Crane Hill over the next 3 or 4 years. Subject to something changing and us wanting to start construction on Shakespeare, Crane Hill, and the approximately 35 million for ADEX and 27 million capital for pre-production capital. That is the largest amount of capital needed. And yes, if we want to move that ahead, and we think it's important to move it ahead quickly, we will need to raise money for that financing. But just like FNX did, McCreedy West financed the restart of Levack mine and a big portion of Podolsky. There's potential to do that again with McCreedy West cash flows. And once we close, I'll be able to give more guidance on that.
Rick, I can see you're winding up your next question, but we
Yeah,
are
Jason,
actually out of time.
Jason, I could do this for hours.
I know, it's just great.
Perhaps we can have a rematch, but as Albert points out, he's my keeper. So I need to shut up, and I need to thank you for, first of all, congratulate you on this acquisition. And thank you for having the courage to face me in the Rural Classroom. We try not to make it confrontational, but these interviews aren't puff pieces. So thank you for having the cojones to show up.
Well, I appreciate the tough questions, Rick. Thanks a lot.
Jason, thank you very much. And yeah, let's do it again soon. Appreciate it.
All right. Thanks.